wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 177. And in this episode, we are reviewing the performance of the financial markets during the 37th week of 2025, and that is from Monday the 8th to Friday the 12th of September. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where consumer prices for a variety of goods and services increased at a faster than expected pace in the month of August, providing challenging economic signals for the Federal Reserve before its policy meeting this coming week. The Consumer Price Index posted its largest increase since January, putting the annual rate of inflation in August at 2.9%, which came out in line with market expectations, but was still 0.2 percentage points higher than the previous month and was the highest reading since January. For the vital core rate of inflation that excludes food and energy prices, this came out at 3.1% in August. The inflation report showed price increases for a variety of goods ranging from clothing to auto parts and electronics, which was a confirmation that tariffs are slowly making their way into the cost of everyday consumer goods. And with inflation running at around 3%, it could negatively impact the U.S. economy, which is reliant on consumer spending as the primary growth engine, given that it accounts for about 65% of the country's gross domestic product. For your information, the Federal Reserve has a 2% target rate for inflation and considers core inflation to be a better gauge of a longer-term inflation trends, and will take this latest data into consideration during its two-day policy meeting that concludes on the 17th of September. In the Eurozone this past week, the European Central Bank held its benchmark policy rate steady on Thursday as economic uncertainty persists in the wake of President Trump's aggressive tariff policies. Ahead of the decision, markets had been pricing in about a 99% chance that the central bank would leave its key deposit facility rate at 2% for the second consecutive meeting. The European Central Bank last cut interest rates in June and has brought down its policy rate from last year's record high of 4%. In its official statement, the central bank noted that inflation was currently hovering around the 2% medium-term target and that the Governing Council's outlook for inflation had broadly remained unchanged. Despite inflation hovering around the 2% target rate, the central bank continues to grapple with economic uncertainty as the United States recently imposed a 15% blanket tariff on all European Union exports to the United States. The central bank added that it will continue to follow a meeting-by-meeting, data-dependent approach and was not pre-committing to a specific path, as it offered a little indication on the future direction of interest rates. On Wall Street this past week, the Nasdaq Composite recorded a perfect week of closing highs for each and every day of the week as investors took into account the weaknesses in the labor market over and above the pace of inflation as a clear indicator that the Federal Reserve will lower interest rates this coming week. According to the CME's FedWatch tool, the futures market has fully priced in a 25 basis point rate cut at the Fed's policy meeting on the 16th and 17th of September. The tech-heavy Nasdaq Composite recorded its second positive week in a row with a 2% advance during that period before settling at 22,141, driven higher mainly by a surge in Tesla shares. The blue chip Dow Jones Industrial Average posted its first positive week in the past 3 weeks as it broke above 46,000 for the first time on Thursday, but lost about 273 points on Friday to close at 45,834. Meanwhile, the S&P 500 rose by 1.6% during the week to record its best weekly performance since early August, as the broad market index hovered around a narrow range before ending the week at 6,584. In the government bond market, Treasury yields edged higher on Friday as they rebounded from Thursday's session, where the rate on the 10-year bond had fallen by 4 basis points but found support at the 4% level. This came after the inflation data came out trending upwards, whilst the labor market continued to show signs of serious weakness. With the current tension between the two sides of the Federal Reserve's dual mandate of inflation and employment, the markets still expect the Fed to implement at least a 25 basis point reduction in its policy rate this coming week. The yield on the benchmark 10-year Treasury bond was up by more than 5 basis points on Friday before coming to a close at 4.06%. Meanwhile, the yield on the 2-year Treasury note gained by more than 2 basis points to end the week at 3.55%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, the US dollar drifted higher on Friday, and this came a day after a surge in US jobless claims and a modest uptick in inflation, which came ahead of the Federal Reserve's policy meeting this coming week, where markets have fully priced in at least a 25 basis point reduction in interest rates. The greenback has risen against the yen over the past 3 weeks and was up by 0.2% on Friday to trade at 147.53 to the Japanese yen. Meanwhile, the euro was flat versus the dollar at 1.1736 as traders reduced their bets for another rate cut by the European Central Bank, as it opted to stay put on monetary policy this past week. In summary, the dollar index, which measures the value of the greenback against a basket of 6 other major currencies, this posted a weekly decline of just 0.1% and was little changed at 97.59. In the commodity markets, the price of Crude oil rose on Friday after a Ukrainian drone attack on Russia suspended loading from the largest port in western Russia, but gains were capped by concerns about U.S. demand. An official from Ukraine's security services confirmed that the drone attack on Russia's northwestern port of Primorsk led to an overnight suspension of oil loading operations at the port. Meanwhile, the International Energy Agency said that global oil supply would rise more rapidly than expected this year because of planned output increases by the Organization of Petroleum Exporting Countries and its allies, better known as OPEC+. In response, the price of the global benchmark Brent crude was up by 62 cents on Friday and settled at $67 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, rose by 32 cents and came to a close at $62.69 per barrel. In the precious metals market, the price of gold rose on Friday, holding close to record highs that were hit earlier in the week as signs of a weakening U.S. labor market reinforced expectations that the Federal Reserve will deliver its first rate cut of the year this coming week. The weakness in the U.S. labor market has futures traders fully pricing in a 25 basis point rate cut by the Federal Reserve, with some traders betting for a deeper rate cut of up to 50 basis points. Given these tailwinds and following the recent increase in inflows into exchange-traded funds, analysts are now looking for gold to rise up to about $3,900 towards the end of this year. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. The precious yellow metal has risen by 39% so far this year and was on track for its fourth consecutive week of gains as it rose by 1.7% this past week before coming to a close at $3,648 per ounce. We now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained fixed versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.24, which was the sixth week in a row that the exchange rate has been at this exact same level. Meanwhile, the sterling pound was priced at 175.13 and the euro was valued at 151.47. And on the regional front, one Kenyan shilling was changing hands for 27.08 Ugandan shillings and 19.07 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.22. Despite the central bank operating a floating exchange rate policy, the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $268 million for a grand total of $11.17 billion, which is equivalent to 4.9 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remained under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances in the month of August 2025 totaled to $426 million compared to $427 million in August 2024, which was a decrease of just 0.2%. The cumulative inflows for the 12 months to August 2025 increased by 9.4% to $5.07 billion compared to $4.64 billion for a similar period in 2024. The inflow of remittances continues to support the country's current account position as well as the domestic foreign exchange market. In the money markets, during the past week, the interbank market was liquid and remained well funded with the support of the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for all lending transactions. This rate was stable at 9.45% and continues to track the central bank rate at 9.50%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 20.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 11th of September, and the central bank received bids totaling to 38.7 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 161%. The central bank ended up accepting 28.9 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 1.4 basis points to settle at 7.97%, whilst the 182-day rate declined by 1.3 basis points to close at 8.01%, and the 364-day rate fell by 3 basis points to average out at 9.54%. At the Nairobi Securities Exchange, during the past week, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 1.7%, whilst the NSE 25, the NSE 10, and the NASI gained by 1.6%, 1% flat, and 0.2% respectively. This takes a year-to-date performance to gains of 46.6% for the NSE 20, 42.6% for the NASI, 33.8% for the NSE 10, and 33.8% for the NSE 25. The stock market performance was driven by gains recorded by large-cap stocks such as Absa Bank, NCBA Bank, and Kenya Commercial Bank, which increased in value by 11.1%, 9.8%, and 3.9% respectively. This performance was however weighed down by losses recorded by other large-cap stocks such as Standard Chartered Bank, Equity Bank, and Cooperative Bank, which declined by 6.3%, 2.3%, and 2% flat respectively. Up next is our topical issue. And this week, we are looking at the Treasury's over-reliance on the domestic debt market. The Treasury has revised its previous plan, which was intended to balance borrowing from the domestic and external markets, signaling the difficulty of accessing funding from external sources. The gross financing requirements of the government for the fiscal year 2025-2026 is estimated at 1.55 trillion shillings, which is equivalent to 8% of the country's gross domestic product. This amount comprises of 901 billion shillings to finance the fiscal deficit and about 646 billion shillings to refinance maturing domestic and external debt obligations. In its annual borrowing plan for the fiscal year 2025-2026, the National Treasury has indicated that it plans to borrow a total of 901 billion shillings, out of which 613 billion shillings will be financed from the domestic market, which works out to about 68% of its borrowing requirements, and the balance of 32%, that is about 287 billion shillings, will be financed from external sources. During the current fiscal year, the government projects to issue treasury bills and bonds to the tune of about 635 billion shillings and is planning to raise an additional 149 billion shillings from the privatization of several parastatals, including the Kenya Pipeline Company, where the government is targeting to raise 100 billion shillings. The Treasury said that the shorter-dated Treasury bills will be issued primarily to manage the government's cash and liquidity requirements, whilst the longer-dated Treasury bonds will be used to facilitate buybacks and switches for liability management operations with a view to managing maturity risk and smoothing out the redemption profile of domestic debt. The Controller of Budget has raised concerns about the over-reliance on domestic borrowing, which raises the risk of refinancing as well as crowding out the private sector, given that banks prefer to invest in government securities, which are perceived as a risk-free investment. Data from the National Treasury shows that by the end of June 2025, the total public debt stood at 11.8 trillion shillings, with domestic debt accounting for 54% of the total, as external debt dropped to 46%. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the best preparation for tomorrow is doing your best today. A quote by H. Jackson Brown Jr. Think about it. Thank you, and God bless.